Launched in November 1993, Franklin India Blue Chip Fund today ranks amongst the top 10 diversified equity schemes by size, with average assets under management of 4,000 crore rupees. True to its name, the scheme is focused on blue chip companies with a negligible exposure to mid-caps and absolutely no exposure to high-risk small-cap counters. The fund, being benchmarked to the Sensex, maps all its sectoral allocation to the index as well. It believes in the traditional philosophy of long-term investment in large-cap companies and is suitable for investors with a low-risk appetite. Franklin India Blue Chip Fund has a strong and long-term track record, including periods of outstanding performances during 1997 to 99 and 2002 to 2004, when it outperformed the market indices by substantial margins. In the last 10 years, the fund has only missed its benchmark in one calendar year. It stays away from high-performing sectors like real estate and infrastructure, which has caused it to miss out on the bull runs in 2007, but this same investment strategy proved to be a boon in the following year during the market meltdown. Let's take a look at some numbers to get a better perspective. If you invested 1,000 rupees in this fund when it launched, you would have 21,680 rupees today. So should this fund be a part of your portfolio? Let's find out.
Thanks, Savan. Well, Dhirendra, the Franklin India Blue Chip Fund, now this is really a steady performer. Other than 2007, over the last 4 years, it's been among the top 10 funds in its category. It's only managed, to miss its benchmark once in the last 10 years. But when we look at large cap funds, they all seem like they have similar portfolios. What makes this fund different? Well, how can a large cap fund really stand out from competition? Why would you recommend this fund to the investors watching?
One is that, the very basic premise for a large cap fund is that they are, bound to look similar simply because large cap universe is narrow. And the only way these funds try to add value or try to beat, there are two set of large cap funds. One is the index fund, which is fairly easy and predictable, and you are likely to get exactly what you get from an index. And these fund managers, their claim is that they will be able to beat the index over a period of time. And some years they don't, but that is the endeavor. And the way they try and do it is be into large cap stocks and try and avoid some sectors or try and emphasize some stocks. And as and when, and mostly they have been right. Mostly this fund has been right. And if they go wrong, they can go wrong very, very badly.
Right, and you were talking about the fact that this is a strong performing fund. For an investor who's watching, who's maybe a little conservative in his view on the equity market, can this be his core portfolio holding? Can this fund be the only fund that I hold?
It can well be. If you are an investor who is investing for 5-7 years, investing and want to have a fairly stable return, this could well be. This is a fund which has done, which has delivered, 25% return over the past 10 years, which is about 1.5 times more than the index. You don't need any more evidence. And this fund remains large cap all the time. The predictability of, the style purity, it has sustained over a period of time. It doesn't move around. It doesn't try to fiddle with its mandate as and when, good times and people try to stretch their definition of large cap. This fund doesn't attempt any of those. So predictability, consistent return, and a credible history. That actually stands out for this fund.
All right, Dhirendra, finally, your rating of the Franklin India Blue Chip Fund, where would you place it?
I would give it a 5-star. And even on a risk-adjusted basis, it has been in the top 10% of the large cap universe.
5 stars there for the Franklin India Blue Chip Fund on Investors Guide, and that's 5 stars is fairly rare as a rating on this show, which means that this is a fund you should keep in mind when you're making your investments next time around. Right, we have one quick question. Parvez Ahmed has written in, he invests in 25 mutual funds every month through SIPs. Now, he tells us he puts 65% of that money in equity, the rest 35% is in debt and balance. He also puts 10% of his money in the SBI Arbitrage Opportunities Fund, and he wants to know if he should reduce that allocation. Now, there are, first of all, 25 mutual funds per month. That makes it cumbersome, it makes it difficult to manage. It's also not the ideal way to approach his mutual fund investments. So, would you recommend he can notch that down? And with that asset allocation, does it make sense for him to just pick maybe 2 balanced funds?
arbitrage funds are, they are like, one should look at it as a fixed income allocation, and that is what most arbitrage funds have become. So I would look at arbitrage fund as a fixed income allocation. 25 funds don't make sense. It's a wieldy thing which is very difficult to keep track of, manage, and if he's having it in physical form, when he'll be getting all his account statements, it might get difficult. He'll have to keep track of 25 debits in a month if he's doing SIP. I think he should look at his asset allocation, how much he's into. Because of his fixed income funds, of these 25 funds and the arbitrage fund allocation, if it's 30-35% into equity, fixed income and remaining in equity for a 25-year-old, then I think, our conservative, our stable growth portfolio, which is made up of the 4 balanced fund, will do the job. He will get brilliant fund managers at work. It will be a manageable portfolio. It will be more tax efficient, because this is something very important which he should understand, that if you invest, assuming that you are investing 30% into fixed income, 70% into equity, and you do it independently through funds, your equity funds, your return from equity fund will be tax free, but your return from debt fund will be taxable by either as dividend distribution tax if you are deriving the returns in the form of a dividend, or 10% capital gains tax, even if you hold it for over 1 year. And the other thing is, if you rebalance your portfolio every year, 1 year the equity goes up in value, you move your money from equity to debt. If you do it yourself, it will translate into some tax incidence for you. If you move your money from fixed income to equity, that will once again might mean some tax incidence. But if you put your money in a balanced fund, the return on your fixed income allocation will also get converted. It will all be tax free, because equity funds, as defined in the tax laws, is that if you have allocation of over 65% and more on an average daily net asset basis, if it is defined as an equity fund, a balanced fund which invests more than 65%, then it will be treated, the return will be treated like that of a equity fund. So all your return, even by having that 30% fixed income in a balanced fund, will be tax free. So that is an important thing when you are thinking of investing for many, many years, and you will get exactly the same benefit with greater manageability.
So that's very clear advice, Parvez. You don't need 25 mutual funds and SIPs every month. What you need to do is pick among our balanced funds, especially if you prefer the 65-35 asset allocation. That would be the most tax efficient and the easiest way to make your investments.